Hello friends, Walt here with the Schultz team. I wanted to get this out to you because there's a lot of misconceptions that go around anytime that the Fed either increases interest rates or decreases interest rates. So let me just be blunt with you. That does not affect mortgage rates at all, period. End of story. It does not. So what the Fed does is they are in charge of monetary policy and they're in charge of inflation. So their whole goal is to kill inflation, to keep inflation down at all cost. Now with that, that means that as we start to see more inflation in the market, they are going to either raise or lower interest rates based upon all the factors that are coming into play. Now, when they raise rates, that is typically sending a message to the market that there's inflation in the market. And inflation is typically a killer on mortgage bonds or interest rates. So if we try to think of the markets in a very simplistic view, and I'm trying to make it very, very simplistic for my own aspect here, really there's money in two markets. It's either in the stock market or the bond market. So the mortgage bond market. We need money to be in the mortgage bond market to keep our rates low. The more money that's in there, the more investors that we have that are purchasing mortgage-backed securities, mortgage bonds, will keep our rates low. If money's in the stock market, typically, again, not always, but typically, money's coming out of the bond market going into the stock market. And the stock market is surging. As the stock market surges, that typically increases interest rates. Now, on the adverse of that, if we look back to several things that really affected our interest rates over time, one would be 9/11. When 9/11 hit, you saw a mass exodus out of the stock market into the bond market. Last year, right now in the first quarter of 2021, last year at the end of March, beginning of April, we also saw a lot of uncertainty as COVID hit. And we saw really investors that had margin calls and a lot of other things. They didn't know where to invest their money, what to do, and they had to pull their money out of the stock market. It wasn't going into bonds. Luckily, the Fed started purchasing those mortgage-backed securities and bringing our interest rates back into a decent realm there. The main point that I want to bring with you here is that when the Fed lowers the Fed funds rate or raises the Fed funds rate, they are doing that to really start to curb inflation and to keep our markets in check. So for instance, if they lower the Fed funds rate, all they're doing is they're lowering the overnight cost of funds that banks charge each other for their money. If I'm not mistaken, there's 5 banks right now that can borrow money directly from the Fed. Otherwise, all the other banks borrow money from those 5 banks. And the Fed is stating that you can borrow at this rate, whatever it is, 0.25%, 0.5%, 1%, whatever that is. Typically, prime is going to be 3 points above that. Anytime that they lower the Fed funds rate, they are lowering some interest rates due to the banks, but they're lowering prime, they're lowering auto loans, home equity lines of credit, things that are based upon prime, whether they are lowering or raising those. And anytime they're lowering the Fed funds rate, they're sending a message to the markets and to us stating, we want you to buy goods and services. So we're going to make things cheaper for you. As we have more inflation in the market, they're going to do the adverse. They're going to start to increase interest rates, make it a little bit harder, a little more expensive to borrow money. And at that point, hopefully slow our spending down, bringing inflation down. So the Fed has a very tough job to keep that inflation in an even check. But at the end of the day, when the Fed lowers or raises the Fed funds rate, lowers or raises interest rates, they're lowering or raising the Fed funds rate, not mortgage rates. So I hope this was helpful. Again, I try to make it in a very simplistic view for myself so that I understand it, and I hope that if I understand it, then I hope that I made it to where you can understand it. Thanks, and have an awesome day. Hope that you're doing well. Bye-bye.